right, let's get started. So let's start with your CBA. So team one. Have you all decided team one? Who's in team one?
We decided it's on birth control.
For what? Pest
So the free birth control.
Oh, okay, okay. All right, just make sure you can find the data on that. I don't know what else available out there, but there should be stuff out there. One thing, go to cato.org is a really good organization. They do a lot of those kind of studies, and just type on the search. But there's probably stuff out there. All right, team three, Jesus, Jonas. What did y'all come up with? All right, Dante.
So I see.
Yeah, I don't understand that one. So say it again. Okay. I'll say car rental. Is there a company that actually does that has data?
Yeah.
Okay. So similar to what we were talking about with Thor, but just with cars. All right. All right, Daisy and Caitlin, have y'all decided?
We're gonna do the Flowers franchise.
Waterbury, okay. Y'all are gonna make sure you can find numbers, right? There should be something out there. Every franchise should provide free information, so. Okay. Team 7. So Jacob. Yeah, I saw that, but I don't think they franchise. No. I looked it up, and if they do, they don't have it on their website. So, yeah, I think they own all their. You can't buy a Starbucks franchise. There are some related. One I found interesting is Dunkin' Donuts. And there's plenty of information on that. I can spell Dunkin'. So there are coffee related ones out there.
Okay.
I don't know, like Seattle Coffee. They might. And there's one right there, best coffee franchises. Ziggy's Duck Donuts. I can't believe there's something called Duck Donuts. Hard Bean, Scooter, PJ. So find out something today. You might just see what's available. Or you definitely want to do a franchise?
That's what we're.
All right, so find your franchise and send it to me as soon as you find out. Team 8, so Emily and Jenia. All right, are you sure they franchise? Are they okay? I don't know how to spell Krispy Kreme. I'll try that. Is there an A in there somewhere? E-R A? 2 E's. Okay. I had a friend, we drove, 3 or 4 of us drove all the way to Austin just for a Krispy Kreme before they had one here. It was pretty good. I would not eat one every year, but maybe every 12 years. All right, so team 7, give me something today when y'all finally decide. So, all right. Now, let me do one quick. Mohammed, Elisa. Oh, there you are. Sorry, I was like, Georgie, Leo, Nasser, Arshika. Wait. Oh, okay. Good timing. All right. All right. Any questions on the Excel applications. So y'all getting through that? So you've got two due, number two, number three due, 2, 3, 4, the next couple of weeks. So you see how I got them pretty well spread out. We'll do cost of capital next. We'll cover that today and on Thursday. Some of them are fairly straightforward. The last two, number 9 and 10, are really straight. 8, 9, and 10 are pretty straightforward. A couple of them on the stock side are a little more challenging, you'll see, but we'll do them in class, and you have the videos, so you'll work through that. Last class, we were talking about forecasting. I just want to say real quickly, you really need to spend some time in your career at UTSA working on forecasting. You can take a modeling class, or just go out to YouTube and type forecasting in Excel, and someone will show you how to do it. If you're accounting or finance, that's a big part of your career, but marketing, management, everybody needs to be able to forecast. When I graduated from UT Austin in '86, I bought a computer, a Tandy by a Radio Shack, two things that don't exist anymore. Spent quite a bit of money. I think I told you about it. Quite a bit of money on a PC back then. It had not Excel, but something Excel-like. Built my own personal budget, detailed all my expenses. And so when I got to be 46 years old, I was like, I want to retire. I knew exactly where I was spending my money. I had no problem retiring, knowing where I spent my money. So I strongly recommend, if you're not in Excel, building budgets, doing forecasting, building portfolios, getting a habit to it, because you're in your, you're young right now. You need to start collecting data. Now I use Excel for all my exercising. I know exactly what I'm doing. Extras, I know what I've done every year. So my goal at 59 is if I did 2,000 circuits in 2020, I'm going to do 2001 and 2000. I'm always going to do one more every year until I get so old it's not possible. But collecting data is really important. That's what these companies have done. They've given us all this historical data so we can use that to try to forecast out into the future. So this is Costco. And I'm doing their income statement. So we built this as a team, one of my investment classes. And so here's our forecast of their revenues. And the way we did that is essentially, we looked at two things: number of stores that we're going to add, and the increase in their membership dues. And the membership dues was actually pretty easy to forecast, because they have a fairly consistent up $5 every few years. So that we can fairly easily guess. I don't know why it's always $5. Obviously with inflation, if you do $5 every 5 years, you're falling behind. But they fairly consistent, 83, 92, 95, 98, every 3 years, every 2 years, 6 years. Sometimes they skip a while. So how many stores? Well, the nice thing about Costco is they have a very specific number of stores they try to add every year. So between the two of those things, we added inflation in there as well. We knew what the revenue per store was. Remember, we did that on paper one. Revenue per store, we added inflation on top of that. And then we put the extra membership dues on top of that. So it gave us, we thought, a fairly reasonable forecast. The other thing you can do when you do a forecast, let's say, there's a good chance in your capstone class you'll have to do some kind of forecast. What you can do with a company like Costco is do your forecast and then go on the Bloomberg machines and look at the forecast they have. And you can compare your forecast to what analysts are saying and see if you have a decent number. Once you get the revenue forecast, boy, forecasting is pretty straightforward. The next thing is their cost of goods sold. Well, their gross margin has been very, very consistent over time. You can just see the last several years, it's averaged right at 13%, and it's been very consistent. So for Costco, we just said keep their gross margin at 13%. That seems really, really low, but that's the nature of Costco. And then we looked at their SG&A expenses, and we looked at that at percentage of revenues, and that's been fairly consistent over time. And so we forecast that out. So we're already down to almost to their net income. The interest expense, the way I do that is I look at their debt from the previous year and then multiply by interest rate. The reason you use their debt from the previous year is if I use their debt from the current year, I'm going to get a circular formula. So I use their ending debt from last year and I forecast that out, and that gives me an interest expense. Their taxes, I look at their tax rate historically, and I just kind of guess on that going forward. So I've got a net income. And one thing I always do with these is I always graph them, because if there's something wrong with the forecast, it's really going to stand out in a graph. And so I put the graph there. What do you think this is right here? Any guesses on that? What really helped Costco? COVID, right? There's the COVID bump. What if our forecast went up like that? If you look at the Bloomberg forecast, they have it doing that. Like COVID happened and they just kept it going. That seems pretty unreasonable to me. So we had it come back to the more longer term trend. But you know, if you have a forecast, let's see if I can find it, revenue forecast. What I'm looking for here. Didn't work. Bill Gates, come on. If you show that to your boss, she's going to automatically ask, what's going on here? You can't, you know, be real careful. This will happen to you in your career, because it happens everybody's career in the first 3 years. So you'll take something to your boss and there's just obvious things on the chart and you're not ready to answer that question. Make sure you step back, because you're so into the weeds, right? When you're doing stuff, step back and look for the obvious stuff, because you know the details, you know the really low details, but you forgot about the obvious stuff. If you don't know why this thing jumped up there, then you've got a problem. So you want to go look at that. So we got a forecast for net income. Then what we're going to do is the balance sheet. Well, the balance sheet, what you're looking for is relationships. So cash and cash investments, I'll talk about that in a second, but accounts receivable, I just looked at accounts receivable as percentage of revenues historically, and I just use that going forward. That makes a lot of sense, right? You have revenues, you have accounts receivable, they should be related. Inventory, I did that as a percentage of cost of goods sold. I just looked at historical numbers and I forecast that going forward. And then property, plant, and equipment, and other assets, and cash equivalents, I did that as percentage of assets. Now, how do I do it as percentage of assets if I don't know what assets are? Well, the way I do that, and it's kind of a little trick, is I just find those assets that are percentage of assets and the ones that aren't. And I try to take everything's a percentage of assets, add up those percentages, and to divide that into the ones, the dollars I already have, and that tells me what my total assets is going to be. There's a way to do it. It's a little tricky on this one. The way to do it, when I was at USAA, what they would usually do is they would plug everything to other assets. And when you do that, when you plug the numbers, you end up with these massive numbers that no one can explain. And I never liked that. I'm trying to get the balance sheet so it doesn't look ridiculous. So here's my other assets. And if I do a graph of that, I don't think it looks all that unreasonable. It does jump around, but these numbers here are actual numbers. And so it looks reasonable to me. There is some noise in these numbers, and what you try to do is go back and try to figure out, why was there noise there? Is that something that's going to happen again or not? But you're trying to get so that wherever you're doing your plug to get the assets to add up correctly, it doesn't get out of line. I remember early in my career at USAA, the guy doing our forecasts, he had a plug figure in other net worth. That number was usually $100,000, $200,000, but 5-10 years out, he had it like at $15 million. It's like, why is it $15 million? And it was just this plug figure. And to me, if your plug figure is massive, it means you got an error somewhere else in the forecast. So those kind of things, you have to find a way to get it to plug, but it will work. My liabilities on accounts payable, I did that as percentage of cost of goods sold. But what I actually did is I did correlations of it to cost of goods sold, selling expenses, revenues. I try to find where was the best relationship, and you can easily do that. Accrued expenses, I did that as cost of goods sold. Unearned revenues, obviously I did that as percentage of revenues. So here I just did a plug. So I did have to have a plug figure, but it's not an outlandish plug figure. Although it does look a little bad out in the out years. So you do all of that, and then you get to your cash from operations and your other items. Once you have a balance sheet and income statement, this part of the statement should automatically feed, and it works. So if you've never done this, if you're an accounting major or finance major, if you've never done a forecast where they all tie together, because you notice my ending cash better be the same ending cash that's on the balance sheet. I can't have my change in cash be $500,000 on the cash flow statement, but have it increase $700,000 in the balance sheet. So they all have to tie together. If you've never done this, don't graduate without doing this. If you're accounting or finance, it's a really big part of what we do in those two careers. If you're a marketing major or cybersecurity, maybe it's not that critical, but I would still think about it. But the most important thing of all is the revenue forecast. If your revenue forecast is bad, everything else is garbage. It's a waste of time. It's a horrible forecast. So make sure you have a good revenue forecast. All right. If you want to learn how to do a forecast, I'll probably do this class again sometime, maybe in the fall. So, you know, sign up for an investment society class, and we've done Facebook and Costco so far. So we'll see. All right, I'm going to move on to other things. I see people on their iPhones. I'm going to assume you're bored, and I'm going to move on. Nothing is more insulting than a professor than look up and see iPhones. So. But it's not just students that do that. I spoke at a conference, and one of the ladies I sat with, she was speaking at the conference too, and I said, man, it's irritating how students use their phones in classes. I said, yeah, it's so irritating, and the whole rest of the conference, she was on her phone. And she was one of the speakers. I turn mine off. To me, everything I do, when someone's speaking, I turn off my phone and I put it away because it's just so insulting to a speaker. It's like, I'm only here because you check attendance. I really don't think you're going to say anything important to my life. But all right, I just told you something really important to your life. So hopefully you heard that. All right, we're going to jump on to weighted average cost of capital. Before we get into it, I want to go to the very end of it, and then we're going to work back to it. All right. So I want to go to the end result. I want to show you where we're going, and you'll see the Excel applications do this. So we're after a formula here. It's called the weighted average cost of capital, WACC. And so the WACC formula actually is very, very simple. I'll give you the pieces, see if you can figure them out. All right, anybody want to try any of these? What is WD? If I tell you that WD plus WE equals 100%, does that help you any? Weight of debt. So WD is the weight of debt. What percentage of their funding comes from debt? So you want to guess what WE is? We say equity. I don't like the word equity because equity means ownership. It's really the weight of stockholders. It's the net worth, but we're going to use E because that's the typical one. What about KD? K is a misspelling of the word. Huh? Cost. It's cost. So K is cost. Why do we use a K instead of a C? Because C was used for something else. Who knows why? So KD is what? Cost of debt. If WD is debt, KD is debt. So KE is cost of equity. All right. What is TR? April 15th is when you really worry about that one. Your tax rate. And which tax rate? Your income tax rate. All right. Why don't we have 1 minus TR on the WE? Because debt is tax deductible. Dividends, buying back your stock is not tax deductible. All right. So that's what we're after. So the weight of debt MEE is the weight equity. Now, if you took the other business finance class, they spend a whole lot more time on this, and they have the weight of preferred stock, they have the issuance costs, they have all this other stuff. I don't want to insult the other class, but that's an incredible waste of time for you to learn that. So we're going to keep it high level because that's what you need to know. First of all, if we did all other stuff, you forget it 2 weeks later anyways. So that's a waste of time. You do need to know this. If you're an accounting or finance major, you need to know this when you graduate off the top of your head. All right. So every finance and accounting major knows this formula. It's one of the most famous formulas in finance. This is not a formula you look up. This is a formula you just know. Extremely important formula. There are other components, but for most people, those other components, most firms don't have preferred stocks, so we can ignore that. And those issuance costs versus the ongoing, those are minute things that a department of detailed people are going to focus in on. So we don't need that. So if you understand the high level, the other stuff kind of falls into place. The other thing I would really recommend that you do is once we learn this, if you do an internship, go find these people that do this. So if any of y'all are going to do an internship at USAA, go find the USAA WAC people. They're out there. It's Laura Bishop's department. It's Dustin Bishop, unrelated. Both of them are named Bishops, but unrelated. USA has a department that does USAA's WAC. So go, talk to me, and I'll get you in contact with those people, and then you can use my name. They still know me there. It's been 10 years. They're all retiring, but I still know a few people there. Say, hey, my Professor Sweet, he used to work there. He asked if I could come, look at what you do for WAC. Take advantage of those interns to go see the stuff you're seeing in class. So at USAA, it's a massive spreadsheet that does their WAC calculation. It's quite extensive. It probably goes on 1,500 sheets deep. Go look at it, ask questions, take advantage. That's the big thing about your intern is you don't want to just sit in a desk doing that one job. So I have contacts in several firms here in town, and we have contacts in the investment society. Take advantage of them. Your internship should be a chance to kind of leave your desk and go walking around and asking questions and doing stuff. But we have contacts that can help you with that. WAC is a good example. You go work for HEB, ask your boss, hey, does HEB have an official weighted average cost of capital? And if they say yes, say, hey, would you mind me go talking to that person? Maybe they'll have contact that you can talk to that person. That's the kind of thing you want to do. Take advantage of internships to kind of see what these firms are doing. So KD is the cost of debt. And we're going to see the cost of debt is going to equal the risk-free rate plus a spread. All right, so we're going to learn that. Where does that spread come from? How do we get that number? And then KE is probably the most famous formula in all of finance. We're going to use the capital asset pricing model, which you're going to see a few times in your Excel applications. All right. So according to CAPM, any of y'all know this formula yet? It probably is the single most famous formula in all of finance. No one knows? Have you ever heard of it before? Have y'all heard of CAPM before? Anybody? Anybody know who invented CAPM? Have y'all heard of William Sharp? Anybody heard of William Sharp before? All right, so this is stuff you know. If you're a finance, we got a lot of finance majors in here, okay? What if you had a roommate who was a physics major and you ask them about Albert Einstein? They said, I've never heard of Albert Einstein. Who's that? You'd be a little shocked, wouldn't you? That's who William Sharp is. If you're a finance major, you know who William Sharp is, all right? He's the father of modern finance, very, very famous. And he wrote the capital asset pricing model. He has a website that's really, really good from his Stanford days. He's got a lot of articles out there that are really, really good. He's doing some good stuff today. He's still around. I'd recommend if you're a finance major, go out to YouTube and type his name in. He's got a lot of interviews that he has done over time. They're all really, really good. There's one in particular. He's interviewed by Andrew Lowe, which I think is a really, really excellent YouTube that you can go out and listen to. So William Sharp, very famous. He won the Nobel Prize in economics. He wrote his famous paper back in the early 60s. He's still around today. He was actually in San Antonio several years ago, and my boss actually asked him a question when he came and spoke. But famous person. So he came up with this formula. We're going to talk about this formula. This is where we're going to spend most of our time on the WACC. But he says it's the risk-free rate. That sounds familiar, doesn't it? That's the exact same thing we use for the debt, plus a risk premium. But his risk premium has two pieces to it: beta and a market risk premium. So that's what he says is the discount rate for stocks. The cost of capital for stocks is the risk-free rate plus beta times the market risk premium. You have one entire Excel application where all you're doing is figuring out that one number. The rest of the semester, I give you the risk-free rate and I give you the market risk premium. So all you have to figure out is beta. However, in real life, they don't give you those numbers. So if you take my investment class, you've got to figure out all three numbers. If you take my security analysis class, you have to figure out all three numbers, all right? I'm a little strange in that where I make finance majors have to actually go out and figure out all three of those numbers. A lot of colleges, they give you these three numbers and they see if you can plug them into this formula. This formula is not all that difficult. How much are they going to pay you to plug three numbers into a formula? Probably not very much. What they're paying you is to come up with the three numbers. So in this class, you only have to come up with one of them. I'll give you the other two. But in real life, you got to figure out all three of these numbers. All right, so it's not a difficult formula. What we've got to figure out is what is beta, what is the market risk premium. The risk-free rate is pretty straightforward. What's the least risky thing you can think of in the world that you could invest in? The least risky thing, the thing you're absolutely sure you would be paid back on. Bonds, and which bonds in particular? Treasuries, yeah. Any of y'all loaning money to Putin right now? Probably not, right? Anybody loaning money to Venezuela right now? Probably not. But loaning money to U.S. government, you loan money to someone that can print their own money, they're probably going to pay you back. All right, so we're going to use the risk-free rate is going to be a treasury rate. So you'll see that, you'll get to practice with that some. So we just have to figure out the spread piece. That I'm just going to give to you. That's going to be pretty straightforward. The market risk premium, we're going to talk about it, but I'm going to give you that. But we're going to spend most of our time talking about beta because that's the hardest thing we have here. And then you have the TR, which is the marginal income tax rate. And I'll give you that number, so you don't have to figure that number out. All right. So when you do, I think it is your next financial application. I think it's number 7. So we're going to do 1, 2, 3, 4, 7. When you do number 7 is actually a fairly straightforward, simple exercise. I give you everything, I think, but the beta. I think you have to come up with the beta, but I make it pretty simple on the beta. And then you just plug the numbers in this formula. All right. On the exam, it's the exact same thing. So your exam question looks a lot like Excel application 7. I mean, identical to it. I just got to pick the company. So on the exam, I don't make you go through quite as extensive of the beta as I do in the Excel application number 8. So you have to do a little bit more on number 8. So that's probably the hardest of all the Excel applications where I make you go through that full thing on beta, but it's such a critically important number. Right, so let's work through this through the notes, but always remember this is where we're headed. We're headed to get the numbers to plug into this formula. And then when you do Excel application number 4, where you're doing the cash handling exercise, I give you a discount rate. That's what we're coming up with. This WACC, this weighted average cost of capital, that's the discount rate USAA would have used to evaluate that project. That's why this number is so critically important. So let's talk theoretically about this number then. So the cost of capital is a discount rate. It's based on the concept that $1 today is worth more than $1 in the future. I'd rather someone give me $100 a day than $100 a year from now. So we talked about that when we did time value of money. Part of it's because of inflation. Right now we're worried about inflation, right? Big deal right now. I don't know, the last inflation number was pretty scary. It seems like gasoline prices have been trailing back down, haven't they, a little bit? I thought I saw them at $3.99 and now it looks like they're at $3.89, but I don't know. I haven't noticed. Y'all noticed that? I don't buy gasoline, so I don't know. A little bit, right about a dime or so. I noticed no one wanted to put the 4 out there, so there's a lot of $3.99s, but it seemed like it's dropped down a little bit. Maybe not in California, but so inflation is a big deal, right? And then there's the opportunity cost from a risk-free standpoint. If you buy a 10-year treasury, it's going to pay you what we call the real risk-free rate plus something for inflation. Now, right now, the 10-year treasury is giving you what, about 2.5%? Not much. It's pretty amazing how low the U.S. Treasury is. So it's been trailing up. So 2.4%. It is getting close to 2.5. So 2.4%. That's a nominal rate. I don't know what the word nominal means. It includes compensation for inflation. So if you buy a 10-year treasury, you're going to get 2.4% locked in for 10 years. That's got to cover you for inflation. What's inflation right now? Almost 10%. So what is the bond market telling you? Well, inflation's high right now, but it's going to drop pretty fast. So you should be happy with 2.4%. How many of y'all get excited about making 2.4% for 10 years? Doesn't sound all that good, does it? Sounds pretty pathetic. So that is not a real rate. The 10-year treasury is not paying you 2.4% plus inflation. They're just paying you 2.4 no matter what inflation is. All right, so it's pretty horrible number. And then you have what we call tips. So the tip yield right now is, I don't know which tip that is. The tip yield, I don't know if this is a 10-year, it doesn't tell me, but the tip yield right now is actually negative. What the tip is an inflation-linked treasury. It pays you this yield plus inflation. So right now it says I'm giving you negative 0.1% plus I'm going to give you inflation. So it's actually negative. So the tip yield is negative. So the tip yield is the real interest rate in the United States. And right now it's negative. Right now you're getting less from treasuries than the inflation rate. It's pretty pathetic, pretty horrible. And so what we say is if you buy a treasury, you're getting these first two things. You're getting a real yield plus you're getting inflation. Right now it's just the real yield is negative. But you want to get at least that. Why? Because you can always go out there and buy the 10-year treasury. And that's low risk. You know exactly what you're getting. So if you invest in Walmart stock and you look at it and it's priced to give you like a 2% return, you're like, why would I buy Walmart if I can buy a 10-year treasury at 2.4%? If Walmart's going to give me 2%, why don't I just get risk-free U.S. treasury? So you want to at least get that. But you also want to get your risk covered, and that's where we're going to spend a lot of time. How much do we add on top of that treasury compensate us for risk? And that's where all the theory of finance comes in. That's the biggest part of finance. So we're going to spend quite a bit of that. And then the last part's just human nature. If people would rather buy jet skis than invest, then the U.S. government, Walmart, all these entities have to provide higher returns to induce you not to buy the jet ski and instead invest. That's just human nature. We're going to ignore that because we're going to assume that's all captured up here If the 10-year treasury yield's really low, that just must mean people really want to invest their money. They don't want to spend it. And so the US government doesn't have to pay all that much to borrow money. So we're going to ignore that last one. So we're going to focus our attention on the nominal treasury plus something for risk. And that's where all of finance is. So what we're going to say is there is some appropriate discount rate that's going to be valuable for discounting every cash flow out there. We start with the risk-free rate as our starting point, and that's usually something tied to treasuries. Is there something less risky than treasuries? Who knows? Some people think loaning money to Microsoft right now might be less risky than loaning the US government. Maybe Microsoft has a lot of cash out there, but they can't print their own money, so that may not be the least risky of all. There are people out there worried about the US Congress and this debt ceiling, that US Congress might actually vote not to pay off its US debt because it wants to make a point or something. We've had a couple of times where Congress has fought over the debt ceiling where they threaten not to pay off their debt. That would be pretty scary. I don't know if y'all saw the debate. Someone was talking about the US government printing a $1 trillion dollar bill. Y'all see that in the news? So that's one way they can get around not having the default on their debt. Obviously, the US is not going to default on this debt because it's unable to pay. It's going to default on this debt because it just chooses not to pay because of political reasons. So it's possible. That probably wouldn't happen with Microsoft. And that's also true with Russian debt. Russia can print rubles to pay off its debt, but obviously they're in far more difficult position in the US right now. So, so we're going to stick with the treasury being the lowest risk thing that there is out there. Where can you get interest rates? The St. Louis Fed is the place to go. They have everything. But what I usually do is I'll just type H15. You type H15, it brings up interest rates, and you can dump interest rates back to my birthday. All the way back to my birthday, you can get interest rates. Actually, even before my birthday. Did y'all know that there were interest rates before I was born? So back to 1962, you can get interest rates on a daily basis. Isn't that crazy? And in fact, you can even go back to the 1800s and get interest rates. So US Treasury rates, we have a lot of data very, very far back there. If you want to look, there's the 10-year Treasury right there. What is the highest 10-year Treasury we've ever? I don't know if it's going to work because of these NAs they have in there. Anybody guess the highest 10-year Treasury ever in the history of the US? You can probably guess what year it was about. When were interest rates their highest in the United States? The lowest in 2000, not the lowest, but 2008 was a recession, so they dropped in 2008. When did 10-year treasuries get high? They get high when people were worried about inflation. When was inflation really high? The 70s, right? 70s. So 15%. Would any of y'all like a 10-year treasury that gives you a 15.84% return guaranteed for 10 years? Would you buy that today? Any takers? That sounds like that'd be a really good yield. What if Russian government debt was paying 15.84 today? Would you take that? Maybe not. All right. What's the minimum? It happened in 2020 in March. Did y'all realize you lived through history? The lowest interest rate in US history happened during your UTSA. Any guesses on that? How low did it get? You know, it's got to be less than 2.4. Did it go below 1%? Were people buying treasuries to get them less than a 1% return? Anybody? How many think it was less than 1%? Nobody? Well, you'd be wrong. So, Brady, how much lower below 1 do you think? 0.5% would be a really good guess. So 0.5%. I actually shorted treasuries on that day. I was like, I think this is the lowest they're gonna get. I think they're gonna go higher. So I bought what was called a TBF. The TPF is the Pro Shares 20-year Treasury short. What it means is if interest rates rise, it's going to make a lot of money. If interest rates fall, it's going to lose a lot of money. I bought that thing at the right time. I sold it just last week because it had made me a small fortune. I was like, wow, I'm sure glad I bought that. But well, yeah, when the 10-year hit 0.5, I had a friend of mine, a former student, he was saying, I think they're going to go to 0.25. And I was like, well, if they go to 0.25, fine, I'll lose a little bit of money, but they're not going to be much lower than that. So I bought it just right and then sold it here. And I could go higher. Yeah, I probably sold it too early, but anyway, it was, I'm not, not trying to get exactly the low point. You can also just type in Treasury yield curve and all kind of sites come up on that. Treasury yield curve. So this right here, daily treasury rates, and they've changed their site, but you can actually go, you can actually go out further than that. They actually have a, I wish they had changed their site. I hate when people change their sites. Yeah, so they've changed their site. It used to be much easier, and I found it, but I can't find it anymore, but it's out there. One thing I strongly recommend that you do as a business major, and I'm going to present this Wednesday night at our investment society meeting, is get a good sense of that interest rates in the United States. When are short-term rates high? When are long-term rates high? What do you know about right now? People are really worried about the 10-year versus the 2-year, that the 2-year might go higher than the 10-year. What does that mean? When the 2-year goes above the 10-year, what is the bond market telling you? We're going to have what? A recession, right? How many recessions have we had where the 10-year didn't go below the 2-year? The answer is none. Every single recession has had an inverted yield. Are y'all taking money in banking yet? When do y'all take money in banking? And y'all don't have to. Do you have to take money in banking? So it's just finance majors. So you're going to have to take it here pretty quick. Probably going to be your favorite class if you get a really good professor, because there's so much going on right now. So understanding interest rates. Interest rates tell us a lot. The bond market actually tells us when they think recessions are going to happen. They tell us what they think inflation is going to do. There's all kinds of things out there. And the St. Louis Fed is one of the best. They have all kinds of free information that you can use. They even have an add-in that you can install on your Excel where you can bring all this data in just in a nanosecond. It's really pretty cool stuff. So understanding interest rates, we're going to use interest rates as our risk-free rate. There's a lot of data out there. There's all kinds of stuff you can look at to kind of understand what is the bond market telling you. So let's start off with the cost of debt. So I used to use this site, but I think it's gone away. I think they went out of business. We'll see, but I think they are out of business. Boy, it looks like a marriage site or something. What is this? It's there, but they've radically changed their site. So someone actually bought them out. So I can't show you that anymore, but I showed y'all last class, I think. Maybe I didn't. Let me show you this. This is a really cool. I built this for the investment society, but I don't think I showed you this. If I did, I'll show it to you again. Does this look familiar? I can't remember if I showed y'all that. But so these are spreads. So on the Excel application, you're going to figure out what this means. So what is 13.7? Anybody know what that is? 13.7 watts. Is it dollars? 13.7 points, 13.7 degrees, 13.7 times. What is that 13.7? Any guesses on that? Do y'all know this term here? What is a basis point? So a basis point is 1 one, well, 1 basis point equals 0.0001%. Or 0.0001 or 0.01%. That's 1 basis point. Okay. So 100 basis points equals 1%. All right. So think about 100 basis points is 1%. All right. Oh, sorry, 100 basis points. So what is 200 basis points? 2%. What's 75 basis points? What's higher, 75 basis points or 1%? 1%, because 0.75 basis points is 0.75%. So how do you figure that out? You just take the basis points and you divide by 10,000. So 13.7 basis points is 0.14%. Okay. So on your Excel application, if you have 148 basis points, you take 148, divide by 10,000, and that's 1.48%. All right. On the exam, that's what you're going to do. If it's 75 basis points, you take 75 divided by 100,000, you get 0.75%. All right. 123 basis points is what? 1.23%. All right. If you're a finance major or an accounting major, you've got to do it in a nanosecond. 15 basis points is what? 0.15%. All right. So you just got to get real fast on that. So the 10-year treasury today was down. Where did it go? There it is. Was down 7.7 basis points. So treasury prices were up today because if interest rates fall, bond prices go up. We're going to learn that here. So the 10-year treasury was down 7.7 basis points. Is that a big day or a small day for treasuries? What would you think? So yesterday, the 10-year treasury was 2.477%. Today is 2.4, so 7.7 basis points. Well, I'll tell you, one standard deviation is about 6.5 basis points. Today was 7.7 basis points. So today was a fairly big day. Bond investors are really happy. I'm really happy I sold that security a few days ago because it would have lost, well, we can even see, it would have lost money today. Hopefully I got that correct. So today it was down almost 1%. So I'm glad I sold it a few days ago. Why? Because it makes money when interest rates rise. But what did interest rates do today? They fell. Did they fell a bunch or little? 7.7. So if you're an accounting or finance major, that's something you better know. If interest rates fell 7 basis points today, that's a pretty big day. You walk into the interview and they say, hey, what did you think about the treasury market today? You better know what to say. Say, wow, that's a really good rally today. Yeah, I saw that. And if you really want to say I want to sound cool, right, in your interviews, right? So if you're cybersecurity, that's even better, right? You walk into a cybersecurity interview and say, hey, man, you see 10-year treasury, man, it's down 7.7 bips today. They think you're a genius because you're outside of your major. Yeah. So you say, yeah, treasuries rallied today. The 10-year is down 7.7, and you don't say basis points. That's not how you spell down. What do you say? Basis points. That's so uncool. It's down 7.7 bips today. You sound like you've been working in finance for 20 years. All right, so you got to be cool. You got to say, yeah, I don't know what y'all say today. Y'all say, and I always answer what when y'all say this. Y'all always say sweet. I'm like, what? But sweet. I mean, it's like, how do we think? Yeah, man, it was a sweet market today. Treasuries really rallied. The 10-year was down 7.7 bips. You don't sound like a college student anymore. You sound like someone who works in finance. Which would you rather sound like in an interview, a college student or a professional finance? You know, that's what you want to do. So, but how do you know that's a big day? Well, because anything more than 6.5 is a big day because 6.5 is one standard deviation. All right, so that's the kind of thing you want to kind of know. The S&P was up 1.23%. Was that a big day or not? What do y'all think? That's not like a big day. But one standard deviation is 1%. So this was more than one standard deviation event. That's a pretty big day. So you walk into an interview, you got to know those kind of things because they're going to ask you. Sometimes they ask you just to see if you're paying attention on what's going on. What's the S&P done this year? So if you go to Investment Society, Anthony, in his presentation, he shows you what markets have done the last week, what they've done year to date, when they've done the last 12 months. He gives you everything you need to know. So if you go in an interview, you know what markets are doing. That's what they're looking for. So I don't know on marketing or cybersecurity what those things are that you need to know. But in finance, it's pretty obvious. What are markets doing? You got to just know that kind of thing. So I've lost this website, but I've given you the data here. So I should update this through March, but it is after February 24th. So this is after the Russian invasion. So historically, let's do triple B because I'll probably give you something more like a triple B bond. A triple B bond, you'll remember that from paper one, that's kind of medium quality. Historically, it's had a spread of 159 basis points. That's 1.6%. So the 10-year treasury is 2%. It's going to pay you 3.6%. You got an extra 1.6%. That's covering you for your risk. The risk of what? Your risk of that thing will default and go out of business. Is 160 basis points enough? Hopefully it's enough. Today that spread's 148 basis points. It's not as much as it's been historically, but it's 148 basis points. So you're not getting as much as you got historically, but kind of in the ballpark. The max is 722 basis points. So if the 10-year treasury is 2%, it's going to pay you 9%. Anybody want to guess when we hit 722? And Dante, you said it earlier. And I want to guess, what year did we hit 722? When was the financial crisis? 2008, right? That's when you saw 2009. I remember November 2008. I don't think I slept a single night that entire year. I can remember tossing and turning all night long and getting up and checking the Japanese market because it was open. That's what we did back then. It's like, oh man, Japan's down another 10%. It's gonna be a horrible day. I don't even go on to work. It was just horrible back then. Really, really terrible market. But what would happen if you'd bought a triple B bond in November of 2008? Would you have been happy? You would have made 9%. You would have been really in great shape, right? You would have bought it at the highest yield possible, and at that point, the market would have come down. You would have locked in that 9%. So that would have been a time to buying bonds right then. Today, you're not getting 7% extra return. Your spread is what? It's only 150. All right. So what is the spread referencing? Risk. When risk is really high, when everybody's worried, what happens to spreads? Do they widen or do they narrow? They widen. Why? Because when you're worried about risk, people have to pay you a whole lot more money to get you to buy that bond. They got to pay you 9%. Today, what can we say? People aren't that worried. Even after the Russian invasion, the spreads are only 150 versus the average of 160 over time. All right. So that's what we're looking for. That spread you're going to add to the risk-free rate reflects risk. And what do you notice about risk? High quality things don't give you much spread. Low quality things give you much more spread. All right. So when you do your Excel application 7, I think I give you Kroger's and I forget who else. And I give you their credit ratings. And based on that, you're going to know what spread you need to add onto that bond. I give it to you, but you have to look it up. You got to say, is it single A rated, triple B rated? You've got to look it up. But that's going to give you the spread. The lower the rating, the greater the spread. And the spread's also the risk premium. So the spread is how much we got to pay you to induce you to buy that bond. If you're really worried the company's going to go insolvent, you got to pay me a bunch. If I had, let's say I had a 10-year Russian government debt, 100,000. What interest rate would I have to give you for you to buy that bond from me? What would you take right now? Would anybody take 25%? Anybody in here? Would you, Dante, 25? Anybody take 50%? Would that be enough? Y'all really think Russia's going to default on its debt? Now, if they default on their debt, they're not going to give you zero, are they? What does Argentina do when it defaults on its debt? It restructures it. So they might give you 80 cents on the dollar. So if I tell you I'm going to pay you 50% and they restructure down to 80, you only lose 20, you still could make a pretty good return, couldn't you? You only lose 20, but I'm paying you 50. You could still be good. So you can see how you have to do the analysis here. So I love what I think it's Howard Marks said this. He says there are no bad assets, only bad prices. What does he mean by that? There's going to be some return that's going to be good enough to compensate you for the risk. So if I own Russian debt, offer you a 99.999% return, you might take that because even if they default, you'll get some money back from Russia. So if the price is good enough, you'll do it even on the worst thing out there. All right, so that's what we're going to look at. I'm going to give you a bond. I'm going to tell you what its rating is. I'm going to give you a table. You're going to look at that table, and that's going to tell you how much extra return you need over the risk-free rate. All right, we're going to do it in basis points. You've got to get really good at basis points. So some of you finance majors, I highly recommend you take John's bond fixed income class. Fixed income is a great career in finance. It pays just as well as everything else, and it's a really interesting world. I just texted my fixed income friend at Victory Capital, making fun of him of his bond prices. His bond mutual funds have done nothing but lost money the last few days. So I told him, yeah, at least today you're going to be up in price. It's about time. He's done nothing but losing money. I have my money in his fund. He's done nothing but losing me money the last few weeks. Why? Because interest rates are up. But today, his bond portfolio better be up today, or I'm going to be really upset with him. Because today is a day where you better make money in bonds. But if you talk to a bond person, they talk 100% in basis points. They don't even use interest rates. So I remember, boy, I got really embarrassed in my first finance job. I was sitting at my desk at a historical time in USA history, maybe one of the most famous days in USA history. USA, for the first time in its entire history, went out and borrowed money in the public markets. Never done that before. The corporate treasurer was in his office. He comes running out. He's so excited. They didn't know how USA was going to borrow money. We didn't know how markets were going to perceive USA as a safe investment. What do you think? Safe investment or risky investment? Pretty safe. At that time, especially, pretty safe. He comes out. He goes, we got it at 10 over. He was so excited. I was the only one there. Everybody was out to lunch. So I'm the only guy, this finance person he hired. And I go, wow, that's great. You got what at what over, what 10 what? I had no idea what he was talking about. What was he talking about? USA borrowed money 10 basis points over treasury. So very, very low interest rate. He was real excited. The bond market said USA is a very safe company. Had no clue what he was talking about. He looks at me, why did we hire this idiot? How could he not know? But I didn't know he was working on that. But he came out, he didn't mention we borrowed at 2.3%. He didn't say that. He said we got it at 10 over. And that's the way a bond person will talk. They talk entirely in basis points. They don't even say bips. They just say 10. I want it at 10 over, at 10. They don't even say 10 over because it's obvious it's going to be over. It's not going to be under. So if you get into the bond world, you have your own language that you use, that you just kind of get used to it. The reason you need to know that is if you interview for a job like that, you better have someone to lingo down because they're so used to it. They're really shocked when people don't know that language. You got to kind of practice it. So start practicing that. Pull up the Yahoo Finance and say, okay, 10-year treasury yield was down 7.7 bips today. Bond market rallied. Yahoo Finance doesn't even do it right. You notice they have it in red? That should be in green, because this is a good day for bonds. When interest rates are down, bond prices are up. So they have the wrong colors here. All right. So the cost of KD is the weighted average cost of a firm's debt. Now it's weighted average of all their debt, because they may have 50 issues of debt out there. They may have some 2-year debt, some 3-year debt, some 5-year debt. We're not going to mess with that. We're just going to kind of just go one number. But how would you find this? Very, very easy. You go to the Bloomberg machine. So how many finance majors do we have in here? Let's see. I know Sergio, you are one. Jesus, aren't you finance? Dante, Josh, we got quite a few. So how many of y'all have Bloomberg accounts? Y'all should all have one. So if you don't have a Bloomberg account, go get one. Join the investment society. We'll help you get one, or go to my YouTube channel. I've got a whole Bloomberg part of that channel. I have people from all over the world asking me for spreadsheets, and I send it to them. But the Bloomberg machine has a button called corporate. It's up there. It's one of the function keys. I can't remember if it's 3, 4, or 5, but just click on that button and hit enter. And it will have a search function. You click on that search function and just click in a company. Click in IBM or, I don't know, Walmart. And when you click on that, it will bring up all of the debt of that company. And you can dump that into an Excel spreadsheet, and you have all of the debt of the company. You can see all of their debt, and you can actually calculate their weighted average cost of debt by doing that. Pretty cool. Or you can just type, guess what? You can go on the Bloomberg machine and just type WACC. So you could do this. You could do IBM, hit the function 8 key, and the letters WACC. And Bloomberg will bring up what they think the cost of capital for IBM is. And they'll show you what the cost of debt is, what the cost of equity is, what the tax rate is. And their cost of debt that they bring up, that you'll see in the WACC function, should be all of IBM's debt on a weighted average basis. So Bloomberg will do a lot of the heavy lifting for you. In fact, if I give you a company on the exam, I might actually pull the data from Bloomberg and just cheat and use their data. So there's great functions out there that you can pull these numbers and get them. So all this number, I'm not making this stuff up. It actually exists in real life. These are real life companies. They borrow money. And so it's out there. What I'm going to do on the exam is I'm going to tell you this firm, their average debt is 5 years. They're BBB rated. So you're going to use 5-year treasury. You can look for their rating, 5 years, for the spread. You'll have everything that you need. All right, let's look at it. All right, so you're going to do this problem. So let's look at it. You're going to see, wow, that's really simple, and it is. So you go down to the financial applications. You load it up. You got one due tomorrow, right? Isn't that true? You go down to number 7 because they're out of order. Well, actually, even number 6, you do it as well. Let's look at number 6. So you're going to see some overlap between number 6 and number 5 and number 7. Because number 5, you're going to value a bond. Guess what you need to value a bond? You need the KD. You need the KD to value the bond. You need a KD to do the WACC. So let's see if you can figure this out. Exxon has a 10-year bond maturing in 5 years. So it's really a 5-year bond. Which treasury are we going to use for the risk-free rate? It's a 5-year bond. Which treasury will we use? It's not a trick question. 5-year treasury. All right. It was a 10-year bond when they issued it, but they issued it 5 years ago. So 5 years ago, you would have used a 10-year treasury. But today, there's only 5 years left, so we use the 5-year treasury. So there's your risk-free rate. And it's rated, well, not anymore, but back then, it was rated AAA. Which spread are we going to use? So 5 years. And which rating? AAA. So what spread are we going to use? 60. Can anybody off the top of your head tell me their KD? 2.6. Very good. You're not even a finance major. So, all right. So 2.6. How do you do that? 2% plus 60 divided by 10,000. That's 2% plus 0.6%. That's 2.6%. What's the KD for IBM? I mean, for Exxon? 2.6%. Pretty straightforward, isn't it? Pretty simple. I'm not supposed to do this. You're supposed to do this one on your own, but a 15-year bond issued 10 years ago. Seems pretty similar. What kind of bond is this? It's a 5-year bond. Which risk-free rate are you going to use? 5 years. It's not even up there. Wait. Oh, it's maturing in 10 years. Oh, I didn't read it correctly. So what kind of bond is that? 10 years. So which risk-free rate are you going to use? 10-year. It's BBB plus. 10-year BBB plus. Anybody do that top of their head? 3.44. Good, y'all getting it. I know graduating seniors in finance that can't divide 140 by 100 by 10,000 doing their head. That's so good. Maybe you should change major. But yeah, I mean that's it. 3.44%. Exactly. See how simple that is. So pretty straightforward. Now your problems are number 7. Calculate the waivers cost of capital for Kroger's. Kroger's bonds have an average maturity of 7. So what risk-free rate are we going to use? 7. Pretty straightforward. You don't have any other numbers to work with, so it's not going to be 3 because there's no 3 anywhere in there. It's AA rated. So which risk-free rate are you going to use? There it is right there, 3.6%. 7-year average, and they're rated AA. Piece of cake. Right? You'll see how that works. You'll do that over and over again, but it's the same thing over and over again. That is the cost of debt for Kroger's. Now, what does USAA do? USAA has debt out there, but it's all different maturities. So they have some debt that's like $1 billion for 3 years. They have some that's $2 billion for 5 years. They're actually going to take each one of those pieces and weight it, but they also have certificates of deposit. They borrow money from their bank customers. They're going to take that into consideration. They also have annuities, so they're going to take that in consideration. That's why you can see why the WACC calculation from USAA is so massive. It has to take all those pieces together and bring them in. All right, but it's pretty straightforward. Once you see it the first time, you just keep doing that over and over again. It's a pretty simple problem. So you'll get some practice on that, but you're going to find it's pretty straightforward. So Bloomberg should do that for you as well. So just remember that. I've seen some students taking the capstone class and they need a cost of debt and they don't know where to go to get it. I say just go to Bloomberg. Bloomberg has it sitting right there on the machine. You can steal that if you want to. They should do a pretty good job on cost of debt. I don't think they do a good job on cost of equity, but I think they do a pretty good job on cost of debt. All right. So all we do is take that pre-tax cost of debt. What is that? That is your KD, risk-free rate plus the spread. That's what that is. The pre-tax cost of debt is your risk-free rate. Risk-free rate, another word for that is what? A treasury with the same maturity as your company's debt. So if your company debt has a 7-year maturity, it's a 7-year treasury. All right. And then 1 minus the marginal tax rate. What's the marginal tax rate? It's the tax rate on the next dollar that they make. Who has that number? The tax department. That's what I did. I call Amy. Amy, what's our marginal tax rate? And that USA is pretty complicated. USA is an insurance reciprocal, whatever, I forget the title. Very bizarre company. It's the only company I know whose after-tax return on stocks is higher than their before-tax return on stocks. Can y'all think of any other entity that makes more money after tax than before tax? That the U.S. government, that we as taxpayers actually compensate USAA for buying stocks. It's pretty wild, isn't it? So I remember when I first learned that, I was like, there's no way that's true. And the tax department says, yes, that is absolutely true. But for most companies, when they make money, they have to pay more in tax. and it's the marginal tax rate. Guess who's going to give you the marginal tax rate? I am. How hard is it? Not very difficult. Their marginal tax rate is 35%. Pretty easy, all right? So I don't make you go through any hurdles on that. I just give you that number. So that's very, very straightforward. All right. So the reason we do that is that interest expense is tax deductible. Essentially what we're saying is, hey, we have this cost of debt, but the US taxpayer is going to subsidize some of that. They're going to help cover some of that. Now, the Trump tax change, or it really wasn't Trump, it was Congress, but he signed it. But the 2017 tax law change, they made one really huge change there where they said debt is tax deductible unless you have too much debt, and they put a ceiling on it. I did an analysis to see how many companies that impacted. It's not many companies, but there is a possibility, I've heard people talking about it, that they stop making interest expense tax deductible. That would be pretty radical if that happens. But right now, as far as we know, it's going to be tax deductible as long as we think. There's other people who want to make equity tax deductible. So if a firm pays a dividend, that would be tax deductible. Right now, that's not the case. I'm actually in the group that thinks that should be the case. And we might talk about that later. You want to see. So I think you can make a strong argument for that. What that would do it would push a lot of tax to wealthy people. So wealthy people pay more like in tax, so they may not like it. But I actually kind of think it would be more efficient if we did that. But there's a chance. There are people arguing that dividends should be tax deductible. So that might mean we need to change the formula and put 1 minus tax rate also on the equity side. But right now, that's not the case. All right. So this isn't set in stone. U.S. Congress can change tax laws anytime they want to. I think it's more likely they'll make debt not tax deductible than they are to make equity tax deductible, but we'll see. All right. So you've got the debt side pretty straightforward. It's actually a pretty easy part of the exam because I essentially give you everything. You just got to know how to pull the data. Here's the bond ratings. Y'all have seen that before, right? So bond ratings. So what we've got to do is the hard part, which is estimating cost of equity. This is where the theory comes in. At UTSA, their spreadsheet for cost of capital is 50, 60, 70 pages long on cost of debt. And it's like one little calculation on cost of equity. It's all theoretical. All right, but the theory is the hard part. So we'll start there. I'll let you out 3 minutes early so you can work on your applications. Let's do some strategizing for the CBA projects. Oh no, that's not good. Right, so everybody's got their project. I'm still waiting on details from, I think, Team 7, but the CBA is what to expect now so that we just know the rest of the semester what we're going to be doing, because it feels like it's a long ways off. But y'all know what tomorrow is, right? Tomorrow's April. April starts, so so what do you need to do? So your focus right now is you're collecting assumptions. If you need help on that, set up time with me and I'll help you find the assumptions. If you're doing a franchise, there's probably a website that will give you that. But you're also collecting the ranges or the best and worst. So while you're doing that, you got to make sure you're thinking in those terms. That's how I recommend on the franchises going to a YouTube channel and just seeing what people are saying about it. Collecting your assumption. How much does it cost? If you're doing a franchise, you have a franchise fees, they'll give you a list of stuff you got to do up front. It might be some building costs. You got to get some equipment. Maybe you're going to lease the equipment. You got to look, but there's going to be some upfront costs. They're going to give you some estimate on the revenues, some estimate on the employees, the advertising, the ongoing, the easiest one is the franchise fee. That might be 10%, 15% of the revenues. There may be a lease on the building. Get all those assumptions together. You want to collect ideas on intangibles. That might be something you assign one of your team members or really focus in on that. Again, that's where the YouTube can really help you out. Sometimes it's just brainstorming. Sometimes it's finding someone who's doing what you're doing and just ask them the questions. So it can be really powerful for your team. If you're doing a franchise, like a Dunkin' Donut franchise, see if you can find a Dunkin' Donut franchise owner and see if they'll just talk to you. You might be surprised. A lot of times I've noticed in Subways, they'll have the actual franchise owner up on a plaque. I've asked some workers, you know, what's your owner like? Is this someone I could talk to? And they're like, no, you don't want to talk to this person. It's like, okay. So, you know, you can get an idea, just talk to the workers. How often does the franchise owner come by? How friendly are they? They look like someone who might talk to a college student. You know, use the, you know, I'm a struggling college student. I got $100,000 in debt, all that kind of stuff. They might talk to you. So you can certainly do that. And then you need to build your base case, and don't go any further than that. Build base case in Excel. You got Excel application number 3 that gives you that to work with. So right there, there's enough work to split with the team members. So make sure everybody's doing something. If you got a specific thing you need to research, set someone off on researching that and get that going. So those are the things you need to be doing. And then somewhere around April 20th, you're gonna meet with Professor on your Excel base case. So you can go ahead and schedule that. Schedule that now. It can be via Zoom. So, you know, we don't have to all be together. We can do it by Zoom. But I do need you to send me the Excel, and that's where we're going to, between you and your team, we're going to sit down and agree that your base case looks correct, or that you need to correct some things. Extremely important to your case. It's extremely important to your grade. That meeting needs to happen. I've had some teams that had a major error in their case that would have just been disastrous, and we, you know, letting me be that kind of sounding board to make sure there's nothing serious. I've looked at enough of these things that I'm pretty good at catching something. So pretty important. I had one case. It was a bunch of doctors, and they're doing this at-home care thing, which sounded really good. And they had this wonderful growth. I thought, wow, that's really wonderful. And I was looking at the numbers, and they had this tremendous growth, but they weren't adding any employees. I was like, how are you managing 3 times more patients with the same 2 nurses? That doesn't make sense to me. And they just accidentally not added that in. So that's why they're making so much money. You know, if 2 nurses can handle 1,000 customers as easily as 200, then boy, they're really good. But it's not likely to happen. That was a major impact on their model. And also help you make sure you didn't forget something. You know, maybe the people doing the duplex forget about property taxes. We got to sit down and look at that. So those kind of things, you know, I'm going to help you with. So you can go in and schedule that now, meet with your team. You might schedule it now so that you have something to work toward. That doesn't mean that's the first time you have to meet with me. So if your team's struggling, I know teams are a pain. I only do a team in this class because it's an honors class and they want us to do teams. I prefer to do individual cases. But if your team's struggling, let me know. I'll get, you know, and if your team's struggling, be the leader, the one that steps up and gets it going. So if you're not making progress, get them going. But if you just need help, set up a meeting with me before that, anytime, and I'll give you ideas where you can find the data. I'll even, if you want to come meet with me in the FSC, I've got pretty good ideas where to find data on this kind of stuff. I've gotten pretty good at this kind of stuff. So, you know, if you're struggling, how do I find this kind of data? I'll sit down and help you and look and find it, and we'll get that going. So Earlier is better, so this doesn't bunch all up at the end of the semester. And then the last week, class into the dead week, into the, not dead week, but study week. That's when you're gonna schedule your final presentation. You can schedule that now if you want to. That will probably be via Zoom. It's possible we'll do a couple of them in class. I don't like doing them in class because I don't like shortening the time. I want you to have full time to do your case. So you could go ahead and schedule that if you like. It can be after the last class. So if you need more time, it can't be after finals. That's getting a little too late, but it can be after that. And then you need to pick a case to observe. So you have to be on your team's presentation. So all members must present, and it can be via Zoom. That's perfectly fine. I'll talk a little bit about that presentation. And then you need to pick a case to observe because you're actually going to critique another case. So that's your requirements. Get the assumptions, build the Excel, meet with me on the Excel, schedule your final presentation, and then watch another team's presentation. So once I get your final presentation scheduled, I'll put it out to the whole class so they can go see which one they want to do, and I'll put the Zoom links if we do the Zooms on that. And then I'll give you a critique form that you can use for the one you observe. So every team will, hopefully have 2 or 3 people watching their case. Your entire team doesn't have to watch the same case. So if you're on team 2 and you want to observe team 7, you can do that even if the other team members are observing team 6 or 5 or 4. All right. So you can pick any one you want to do. You can pick it based on what you're interested in, which would be the best, and or pick it based on your schedule and what works best for your schedule. All right. The case you observe is essentially 10% of your grade. So you have to observe another team and get feedback on that team. What about the presentation? So here's my philosophy on this. It can be all in Excel. I'm perfectly fine with that. All right. I know you're honor students, so you want to go out there and do that amazingly over the top PowerPoint presentation. You can do that if you want, but I don't need that. You can do your entire presentation. Even the intangibles, you can type the intangibles in Word and then do a snip in the Excel, so it's all in one big presentation, however you want to do it. If you do it by Zoom, you'll probably have one team member that has the Excel and they're controlling it. Everybody else is speaking to that, so you don't have multiple files loaded up, that kind of thing. But you can do the entire presentation from Excel. I don't need a fancy PowerPoint, but don't forget the intangibles. That's probably where most of the points are missed. Teams like throw intangibles together. I want someone to have specifically to talk. Here are the intangible benefits. Here are the intangible costs. Here's how we handle them. This is what we think about them. And I want it to be expansive. I don't want it to be just 1 or 2 really obvious things. Think through it in detail. If you're doing a franchise, franchises are a pain. For the franchisee, stuff goes wrong. It takes a lot of time. It can include things like we're providing jobs in the community. However you want to handle the intangibles. There's a bunch of them, but they need to be meaty. So that's what you have for the rest of the semester, other than the final exam. And the final exam you're preparing for by doing your Excel application. So you're getting that done already. So there's nothing new to do on the exam other than come to class, take notes, and do the Excel application. So this is the big thing. Any questions on this? Don? I'll have to see on that. I don't know how to. Yeah, we'll see. I'll figure it out. I can't remember what I did last year. Yeah, it's tough because we don't have the ability. I don't know why UTSA or other schools don't have the ability to do Excel in class without it having access to the internet or anything else. I don't know why schools can't provide kind of dead Excel. So I'll see. I can't remember what I did last year. So questions on the case, you'll see what you're doing. Don't start working on this in 2 weeks. Start working on it like last week. Right, so you should have your assumptions and don't have one person doing everything. I will send out, just to let you know, a team assessment. So if I get a team assessment and they're all about the same, then it won't have any impact. If the team assessment comes back and says, yeah, we all worked about the same except for Bob, man, Bob put in extra 50% than everybody else, then Bob might get a little bonus. So everybody did well except for Bob. Boy, he never came to anything, never did anything. Then if everybody's consistent on that, then yeah, you can have some impact there. The team assessments will be anonymous. I mean, will be private. They won't be anonymous. I need to know who submits them, but I won't share them with the team members, but it could affect someone's grade. But hopefully everybody's putting equal work in. So make sure you're not one of those team members everybody hates on the team because you don't do anything. I remember my team, we had one guy on our team, he showed up to one meeting, told us how stupid we all were, and we never saw him again until the presentation. And then after telling us how horrible our paper was, he just read our paper in the presentation completely out of order. And I was really mad that one of the people on our team let him read because he had no clue what he was doing. It was just horrible. I've never seen that guy the rest of my life, and I'm really happy I haven't. I don't know what he's doing, and anyone like working with him. Don't be one of those people. You're honor students, so you should. Everybody should just be. Your problem should be people want to do too much. Like, no, I'll do that. You know, everybody wants to have something that you want to contribute. So be strong. You might be a little later contributor if you're going to take responsibility for the Excel. You got to get the assumptions for everybody else, but you could go ahead and start building the Excel and what assumptions y'all need. So anything else on the CBAs? Everybody see how it works?
For the April 20th or around that time meeting, should we email you for that, or will there be like an Excel sheet?
Email me, and I'll get on this meeting. I'll probably set up the Zooms unless y'all want to, but I'll probably, I mean, if we do Zoom, or if y'all wanted to come to campus and meet, I can do that even on the weekends. I don't mind coming up here, but Zoom works perfectly fine on these kind of things. On this one, yeah, we'll set the time. Once we set the time in the Excel spreadsheet, I'll actually put the Zoom links in there. So if you want to look at this, watch Team 2, you can get that Zoom and get into it. So yeah. We will record them, and I'll put the recordings out there, but I prefer every one of you, if you're observing the team, that you're there live so you can ask questions. If we get desperate, someone just absolutely couldn't go to anything, I'll let you get away with observing one later, but you probably lose some points if you do that, but at least get some credit. But I prefer you be there ready to ask questions so you can see how other teams are handling that. But you only have to observe one. You can observe them all if you want to. I mean, there's no limit. So if you want to look at 4 or 5 other teams' presentations, if your team's doing a franchise and there's another one doing a franchise before your team, you want to say, hey, I wonder what they're doing. That's perfectly legitimate. No, you can observe whatever case you want to observe. Yeah, the cases are that you observe are independent. All right. Last year, boy, they were really good. I was very, very impressed. They had one on, oh, I can't remember. It was a good hodgepodge of teams. There's a few that had some, the dance class one struggled because they couldn't get good data. And if you find that you just can't find data, then if you need to real quickly change your case, then let me know real fast. You don't want to let that go more than a couple of days. So you definitely this weekend want to have a good workload of getting this done. I mean, get it out of the way, get it done. Earlier is better. There's no reason to procrastinate. It doesn't help you on this. Okay, so we're doing cost of capital. Last class, I gave you the formula. We handled the first part of the formula where we got the weighted debt times the cost of debt times 1 minus the tax rate. And the cost of debt, we showed that we're going to tie that to the maturity of the bonds and their credit rating. So that's very straightforward. So now we're going to work on the cost of equity. And this very, very famous formula, the risk-free rate plus beta times the market risk premium. So we're going to spend most of our time on beta, and you'll have a big question on the final exam on beta. It's going to look very much like your Excel application. And then we'll talk today about the market risk premium as well. So we're getting close to having the entire formula in there. So we're working toward this thing right here. Not a hard formula itself. You just plug in the numbers and do the math. So cost of equity, it's very theoretical, but the theory is actually pretty good. and a lot of people do use this. We just had a team present for the CFA Research Challenge. They actually won first prize. They used CAPM in their presentation, and the judges were fine with that. One judge had a question that I strongly disagreed with, which is how pension plans affect beta, but it was a theoretical. So there's a lot of theoretical here, and people disagree. But the theory is great. You got to know the theory. If you're a finance major, you're going to see this practically every finance class you take. We just keep giving this to you over and over again. CAPM is really, really important. And CAPM has become a life of its own. It was real big in starting index funds in the United States. It was real big with hedge funds, real big on things like market neutral and alpha beta separation. There's just a lot of stuff that this has driven. So that's probably one of the reasons William Sharpe won the Nobel Prize, is this theory has really had a life of its own. It's really driven a lot of finance. So let's get into the theory and make sure we understand it. And what the capital asset pricing model says is there's risk to just buying stocks in general. Y'all agree stocks are risky, right? They're down today, aren't they? Not dramatically, but they're down about 0.9% today. That's a lot to lose on a stock, 1% for the Dow. So stocks are down today. What are bonds doing today? 10-year Treasury, the yield's down, so bonds are up today. So bonds are rallying a little bit. I'm kind of happy about that, right? Because I sold this thing at 18 and it keeps dropping because it drops when rates fall because it's negative on bonds. So they're risky. So why in the world would you buy a stock if they can drop 1%, 2%? In 2008, there were days when stocks were dropping 10, 11%. Those were horrible days. There were days they were up 11%. Very, very risky, really volatile. And so what the theory says is just buying stocks in general, you need some extra return. That's where that market risk premium comes in. The market risk premium is how much extra return you need just to be in the stock market. But then not every stock's the same. So we're going to take that market risk premium and then we're going to adjust it for individual stocks. Some stocks are going to be more risky than average, some are going to be less risky than average, and that's where beta comes in, all right? So in your notes, I would associate this with the market risk premium and associate this with the beta. Right? So stocks in general, that's where we're going to add a premium just for stocks in general. And then the beta starts at 1. So you start with 1. So if your beta is 1, then you're going to have the same market risk premium as the average stock. If your beta is 0.8, you're going to reduce that premium for your stock because it's less risky. If your beta is 1.2, you're going to increase that premium because your stock is more risky than average stock. All right. So beta is somewhat of like a sliding scale. So those are the two pieces. And the capital asset pricing model is the most popular model out there. And here's the formula for it. We've already seen it several times here. I will warn you, this market risk premium is also known as the equity risk premium. And I do switch back and forth quite frequently because I'm just in a habit of switching back and forth. So if you hear me say equity risk premium, that's the exact same thing as market risk premium. There's no difference. There's no nuance or anything to it. They're exactly the same thing. All right, so we've got 3 pieces here. 2 of these inputs apply to every single stock exactly the same. All right, we're going to use the exact same risk premium for every single stock, whether they're doing Facebook or Walmart or IBM. They're all going to have the same risk-free rate, and the market risk premium applies to every stock equally as well. So whether we're doing Facebook or Walmart or Campbell Soup, we're going to use the exact same market risk premium. The only thing that differs between stocks is the beta. All right. The risk-free rate, I'm going to make this pretty easy for you. It has been debatable. It's not so debatable today as much as it has been, but the tradition on the risk-free rate is to use the 10-year Treasury. Why 10-year Treasury? It's the most important interest rate in the world. You notice on Yahoo Finance, it's the only interest rate on Yahoo Finance. Everybody's talking about the Fed funds rate. The Fed funds rate is not on Yahoo Finance. The 30-year Treasury is not on Yahoo Finance. The 10 and the 5-year is not there. It's the 10-year that's the most important rate. Why the 10-year? Well, it's the rate that prices a lot of securities. So if you're doing a mortgage, 30-year mortgages are not priced off the 30-year Treasury. They're actually priced off the 10-year Treasury. Stocks are priced off the 10-year Treasury. Why don't we use the 30-year Treasury? Well, but the 30-year Treasury is a very unusual bond. Not many people buy the 30-year Treasury, so it's got this really unusual market supply and demand. It can do really squirrely things. Same thing with the 20-year. And in fact, there were several years there where the 30-year didn't exist. So it was funny to me. I was at a conference, an inflation conference. It is at a time where the U.S. was actually paying down its debt, which you probably think that time never existed, but there was a time where we actually had surpluses. And at the conference, someone from the U.S. Treasury was speaking, and they asked them, they had paid off all their 30-year Treasuries. There were no 30-year Treasuries. And someone asked, well, the U.S. government issued 30-year Treasuries again. And the guy said, no, we're paying down the debt. We probably won't ever do that again. Well, we solved that problem really fast. And the deficit ballooned again. And now we have 30-year Treasuries. But there was a time where they just didn't exist. For several years, there were no 30-year Treasuries. 10-year will probably always be there. It's a very, very popular bond. And it's not that the government has to borrow 10 years, but if the government borrows 15 years, then 5 years later, that becomes a 10-year Treasury. All right. So all we need is a Treasury has about 10 years left, and that becomes a 10-year Treasury. So there's plenty of them out there. It can be a 30-year bond that was issued 20 years ago, whatever. So the 10-year is a very, very liquid bond, very common bond to use. So we'll use the 10-year Treasury. Now, back in 2020, the 10-year Treasury hit its all-time low of 0.5%. Ridiculously low number. So the argument a lot of people said is, how can we use 0.5% as our risk-free rate when it's so low? And I used to make an adjustment for that, but I'm not making the adjustment today. With the 10-year Treasury getting back up to 2.3 or so, we're just going to use the 10-year Treasury and not worry about it. But if you want to get more into that, Dr. Damodaran is the expert on this, and he has addressed that issue. So risk-free rates, dealing with historically low risk-free rates. It's an old article, so we've had low interest rates for quite some time. So at the time in 2011, he was writing interest rates were not that much different than they are today. That 175, the 10-year Treasury was there just a few months ago. So it really hasn't changed all that much. This is something people say, you want to know what's going to happen in the United States, just watch Japan, because Japan's had really low interest rates for 20 years. We've now had really low interest rates for 10 years. You know, we're in this kind of deflationary low interest rate environment. This year we fix all of that with the higher inflation, but who knows how temporary that's going to be. But he writes about it here, and he has four approaches. He has what he calls a dysfunctional approach, the depressed approach, the denial approach, and the dynamic approach. Which one do you think is his? Dysfunctional, depressed, denial, or dynamic? Any guesses on which one he's proposing? Which one sounds the best? Dynamic, yeah, he's proposing dynamic. I was in the denial approach. He says you should adjust. The first two, the functional and the depressed don't even make any sense. So the question is, do you adjust the rate because it's so low? Or do you just use it? And that's what he's recommending. Just go with the 10-year Treasury no matter what it is. Now, I don't know what he was saying when the 10-year hit 0.5%, because that's a really, really low risk-free rate. But anyway, if you want to read it, he does have, if you're a finance major and you're not reading Damodaran, start reading him. So he has a blog. He's retired now, but he's still writing. And he writes some really, really good blogs. And they're very lengthy, but really, and he has YouTube videos. So even though he's retired, and he has videos on what's Uber worth as a stock. what's Tesla worth as a stock? And he goes through it in detail. He is some of the best YouTube videos out there. So yeah, just take advantage of him. Russia and Ukraine, let loose the dogs of war. And he talks about what that means for markets. Just really, really good stuff. So really good writer, very understandable too. His classes are a little complex. There's a few things he covers in his classes, so it would be a little tough for undergraduate. Although if you watch his corporate finance class, probably 80% of it we've covered in here, and you wouldn't have any trouble following it. There's 20% he gets a little kind of graduate level, but most of it you could follow. But he's a very easy to understand presenter. He's presented at places like Google invited him to come present. So a bunch of IT people, and they all understood what he's talking about. So he's a really good person out there. But for our purposes, we're just going to use the 10-year treasury. All right, it makes it simple, but do be aware there are people who talk about adjusting it. If you take my other classes, you'll probably have to adjust the numbers. So be ready for that. So let's spend some time on the market risk premium. So the market risk premium is how much extra return should you get investing in stocks in general over the risk-free rate that would be enough to compensate for the risk of stocks. Because you can always go out there and buy that 10-year treasury. It's yielding 2.3%. You buy it, you're going to make 2.3% for 10 years. Pretty assured, not much doubt about that. You're pretty happy with it. You could always do that. So if the stock market's priced to give you 2.3%, and that's your expected return on stocks, you might as well just buy the treasury. You know for sure you can get 2.3% there. Why would you invest in something else to make 2.3% when there's a lot of risk? So we got to get some premium. If you thought stocks were priced to give you a 30% return, you'd probably put a lot of money in stocks right now because that sounds like a really, really good return. If you thought stocks were priced to give you a 3% return, you say, yeah, it's not worth it. I can buy municipal bonds that making that much and I don't have to pay tax. So how much is it? And that's the big debate. How important is this number? I just put something out on my website. If any of y'all want this, let me know and I'll send it to you. But it's something JP Morgan created. Hopefully this will open. Sometimes Adobe is doing this. You don't have to, get it open. This is published back in 2008. It came to my desk. Oh, don't do that. Hopefully that's not going to be an issue. It came to my desk to transfer it around the company. It may not let me do it because Adobe's got that problem, but I was supposed to rate it initial and send it to the next office. I took it home with me and the next person never got to see it. So I essentially stole this from USA. I thought it was really, really good. What are they talking about here? The market risk premium, what do they say it is? One of the most important numbers in finance, is that what they say? It's the most important number in finance. That's pretty bold claim to say. I've seen other people say the exact same thing. I think Warren Buffett calls it not the most important number in finance, but the most important number in investing. So it's a very, very important number. It's not gonna let me, it's not gonna let me do whatever. So who knows why I don't know why Adobe, they want money from me or something. But what JP Morgan does here, if I send it to you, you may not be able to actually use it. But if I send it to you, what they did is they go through every approach of calculating this number. And there's multiple of them. And so I can't show you what they do, but let me walk you through the approaches. So market risk premium. First of all, it's a theoretical number. So there is no place to go get this number. We're asking how much does the average investor need as an expected return on stocks to compensate them for risk. We don't know where to get that number, but there are some approaches. Some people say just do a survey. Let's just go out and ask people, how much do you need stocks to make over bonds? But if you do that, you're probably going to get the result of these other approaches because that's probably what they're doing. But again, it's subjective. You go out and ask 100 people, you'll get many different numbers. So surveys an approach. You can look historical. So the historical approach, all it says is, hey, let's see what stocks have earned historically. Let's see what the risk-free rate has been historically, and just that difference, we'll just assume stock investors, whatever return they got over the risk-free rate, that was the return they needed to compensate them for risk. So the historical approach just assumes history equals expectations, requirements. So if stocks made 10% versus bonds, risk-free rate being 4%, and the market risk premium was 6%. So historically, stock investors have made 10%. Historically, the risk-free rate's been 4%. So historically, stock investors have needed 6% premium over bonds to induce them to buy stocks. Now, is that a good assumption? Well, it's possible that historically stock investors got a surprise and made more than they were expecting. So it doesn't reflect what they required. Maybe they required 4%, but they just got really, really fortunate and they made 6%. That's possible. I use the historical reports approach the first 20 years of my career, or 15 years of my career. I was a historical approach person. And that was the way almost everybody did it. And in fact, we all did it the same way. It was the Ibbotson yearbook, this purple thing, maroon thing. This would come into my office every year. He's still publishing it. He doesn't work there anymore. Ibbotson, Roger Ibbotson, he sold his company to, I think, the Morning Star. But this is, they're still publishing this. Now they call it the Duff and Phelps. But what he did is he went through and got historical returns on stocks, historical risk-free rates. And then there's one page, I remember I got this book, it was an expensive book. And I would flip through it and there was a page that had a big X on it. And I knew the market risk premium was on the page next to that page. So I get this book, we spent all this money on, I flipped through it, found the X, photocopied the page next to it, sent that out to everybody at USAA and filed the book away. So I didn't need the book for anything else but that one number. But that's what he did. He provided that information. It's called Stocks, Bonds, Bills, and Inflation. So SBBI. You can still buy it today. It doesn't look like the 2021 books out there yet, but it might be. Yeah, there is 2021. It's there. I don't know how much it costs. Maybe they would tell you. There's Dr. Ibbotson right there. I met him one time at a conference that he was giving. He used to give a conference. And I had one question for him. I was so excited to ask the question. USA had just issued catastrophe bonds, and I want to talk to him about catastrophe bonds. So I started talking about cat bonds. He'd never heard of a cat bond. It's like, what's a cat bond? He looked at me like I was weird. So my only experience with him, he thinks I'm a weird. It's like probably calling the police to have me stay away from him. But yeah, it's like cat bonds. What's a cat bond? But catastrophe bonds. He had never heard of one. Which is pretty cool, right? This famous person asked him a question in finance. He didn't know, he had never heard of it before. So that's kind of cool. So that's the historical approach. We use that. You can still do that. It's still available. It's still out there. But what came along after that, that we're going to use is called the implied approach. And so let's get into this theory because I think it's actually pretty cool. I read an article and I actually provide this article to a lot of classes. So if you want the JP Morgan and if you want the implied approach article, let me know and I'll send it to you. The implied approach article was an article written by some people at Barclays. Really good article. So I provide. Now, if you look at the JP Morgan, I wish I could actually show it to you. If you look at the JP Morgan, you'll notice all over the place it says do not copy. So you're thinking I'm violating copyright, but I actually emailed them and got their permission to provide this to my students. They have updated it. I was so excited. We had a student working for JP Morgan and he goes, Ron, I know I know the people who did that report, and I can get you an updated version. I was really excited. The next week, he took a job at a hedge fund and didn't give me the reports, so it didn't work. So I was so close, but so that's out there. Yeah, it's like I'm completely frozen for some reason. All right, so what is the implied approach? So let's look at it, because this is, I think, really, really interesting. They said there is a required return on stocks. Required return on stocks, that is what CAPM is telling you. So the required return on stocks, it's the return on stocks needed to compensate. And that's what we're looking for. What is that required return on stocks? But we don't know where that is. We don't know what that number is. We could do surveys to try to figure it out. We could look historically and assume history will repeat itself. That's not a number that exists anywhere. However, there is a number that exists, which is called the expected return on stocks. What do we expect stocks to earn going forward? So we're going to look at that number. That number we can produce. And then we're going to assume the expected return on stocks equals the required return on stocks. We're going to assume those are the same thing. We can't get the required return because that's a theoretical number, but we can come up with a pretty good estimate of what the expected return on stocks is. Let's just assume those two things are the same. Well, why would you assume that? Let's say that the required return is 10% and the expected is 8%. So investors need a 10% return on stocks to compensate them for risk. But the stock market's priced to produce an 8% return. What's going to happen here? If you need a 10% return and the market's only going to give you 8, what are you going to do with your stock portfolio? Are you going to be buying or selling? You need 10 and you're only going to get 8. You're going to be selling. If you sell, what's going to happen to the stock market? Everybody needs 10, but they're only going to get 8. They're going to sell. Stocks are going to fall. As stock prices fall, what happens to your expected return? You can buy stocks cheaper and everything else is the same. Your expected return is going to do what? It's going to go up. How high up will it go? Stocks will keep falling until the expected return hits what? 10%, right? So if they're not equal, what if we go the other direction? What the expected return is 10, but the required is only 8. What are people going to do then? They're going to be buying stocks. What are stock prices going to do? They're going to suit up. What's the expected return going to do? It's going to fall. Those two should be the same number. Don't you agree? If markets are efficient, investors are rational, those two numbers should be the same. So I think this is a perfectly logical assumption. If we can figure out the expected return on stocks, we can just assume that's the same as the required return on stocks. Now we got something to work with. All right, so that's the implied report. We're going to come back to that. There are other approaches, and you can get that out of JP Morgan. He has one called the VIX approach. Y'all know what the VIX is? Dante, have you seen the VIX yet? So the VIX, you can actually get it off of Yahoo Finance. You just do Shift 6 and VIX. It's called the volatility index. Right now it's at 21%. So what is the VIX? Well, we don't cover options in here. You probably have heard of stock options. We don't cover options, but when you price an option, the most important input into the option is the assumed standard deviation of that particular security going forward. The VIX is that assumed standard deviation of the overall market. And that's what they use. So essentially the VIX is what the stock market or the option market thinks that the stock market, the S&P 500, what its volatility is going to be going forward. 21 is actually a pretty high number. The average historically has been around 15, 16. Why would it be elevated right now? Well, there's a guy named Vladimir who's probably having some impact on that. There's also inflation numbers. There's some uncertainty. So the VIX is somewhat high right now. But this is what the market thinks volatility is going to be going forward. It's a risk measure. It's what JP Morgan says is The market risk premium equals 30% of the VIX. How did they get that number? You have to read their article, see how they got that. So if we did that 30% of the VIX, what would the market risk premium be today? What's 30% of 21%? About 6.3%, right? So that's a pretty easy approach if you trust their analysis. How low can the VIX get? It can get below 10%. You can look at it historically, or actually we can even do a graph. So you can see it got pretty low. You can tell where 2008 is, can't you? Look how high it got in 2008. You can see where COVID was, see how high it got. So it can definitely rise up there. We can get really low. When it gets low, I start doing transactions. The VIX gets low, I do some really wild transactions, and boy, they make a lot of money when you do them. So I love it. When the VIX falls below 10, it doesn't look like it fell below 10 here because they're not doing intraday, but when the VIX falls below 10, I start buying. And I buy stuff I really, I think, or it's almost a sure bet. So that's an approach. Another approach is corporate bond spreads. What's a bond spread? We just talked about that, right? You take the risk-free rate plus the spread. Risky bonds have really wide spreads. Safe bonds have really narrow spreads, but in a recession, what happens to spreads? They all gap out. Every bond spreads goes higher. Well, what JP Morgan argues is when things are risky, bond spreads will be wider. When things are not risky, bond spreads are narrower. So they have a formula that says we can figure out the market risk premium by looking at corporate bond spreads. When they're wide, the market risk premium must be high. When they're narrow, it must be low. So that's another approach. They use a few other approaches. I won't get into them because I don't think they're very good approaches. One's called the dividend discount model approach. And there's a few others that they have that I just don't think work all that well. Mainly because to get the market risk premium, you got to get other assumptions that are just as equally as difficult to get as the market risk premium. So it's like, forget it. It's just, so there are others. JP Morgan does a really good job of covering not only what the most common ones are, but also giving you a really great history of each one. So you can see which one's the highest, which one's the lowest, what are they doing today? They do a really good job of that. But today, most people have shifted to this approach, the implied approach. So that's what we're going to use when you do the exam. That's what you're going to use. So you'll see that. So what is the expected return on stocks? It's actually pretty easy. If you're buying a stock, you're getting a dividend. Dividend with a D, right? That's dividend. Come on, Bill Gates. I don't know why you don't like that. Did I misspell it? Sometimes you have to trick them. Plus expected returns growth. Stocks are easy. That's what you get. You get the current dividend yield plus you get expected earnings growth. Pretty simple. Expected earnings growth is a function of economic growth. Why is that? Well, if our economy is growing 7%, corporate earnings can't grow 20%. It's just not possible over the long term. If our economy is growing 7%, corporate earnings shouldn't be growing 3%. Corporate earnings are a fairly constant percentage of our economy. So if corporations are growing at 20%, our economy is growing at 7%, eventually in 20, 30 years, there's nothing in the United States other than corporations. There's no consumers, there's no government. What's the chances of that? If there's no consumers, then where's all this corporate earnings growth coming from? Don't they need customers? So corporate earnings stay about 14% of our economy. So if our economy is growing 5%, corporate earnings are probably growing about 5%. All right. Well, that begs another question. Where does economic growth come from? Have y'all had macroeconomics yet? So we got couple of economic majors in here. Where does that come from? Where there's three pieces. Productivity growth, labor growth, and we're doing this on a nominal basis. So we also include inflation. So we are nominal. We're not doing this on a real basis. It was real economic growth. You exclude inflation, but nominal economic growth, we include inflation. Why? Because when you buy a stock, you do get inflation. That's part of your return. Stocks do raise their prices with inflation. So inflation eats into your returns, but also corporations can actually help you with that by raising their prices. You don't get that protection with a bond, right? You buy a bond at 6%, it pays you 6% no matter what inflation does. But if you buy a stock, inflation rises, they can raise their prices and you may get some protection there. All right. Now, does that actually work? So let me go to it. Hopefully the Zoom is working here. So hopefully I'm sharing. It looks like I am. Okay. I need to give y'all this chart as well, but I have it in my all right, I'm going to go back to a previous semester. I know I have it out there, but I'm so bad at my Blackboard. I don't know where I put stuff. So I'll go back a semester. All right. So you should be right now saying, I don't believe what you just said. That doesn't, I don't believe it. All right. Hopefully that's what you're saying. How often do y'all tell your professors that? It's like, you got to be joking. There's no way that's true. So, all right. So let's start with the first one. Does the stock market give you dividend yield plus earnings growth? And I was curious about that. I said, well, I'm curious. Let's go back and see. So I went back to 1871. Anytime you see 1871, where's that coming from? There's two dates. There's 1922. This starts, guess when this starts? 1922. Anytime you see 1922, it's Ibbotson's data. When you see 1871, whose data is that? Let's see. I've just forgot the guy's name. Oh my word, I just forgot what's the guy's name? Oh my word, bad memory. But anyway, 1871. Let's see if he pops up here. There he is, Robert Shiller, excuse me, Robert Shiller. When you see 1871, it's Robert Shiller. Now, I don't know where Robert Shiller got stock information from 1871. What was in the US stock market in 1871? A few banks, a few railroads. I don't really know what was in it, but he has his data. Not only that, I don't know if you've heard of the CAPE ratio, but he's the CAPE ratio. He's a Nobel Prize winner as well. But he actually provides you not only his data, but he provides it for free in an Excel spreadsheet. So if you want the data back to 1871 in the stock market, here it is. There's all the data back to 1871. US stock market in 1871 was 4.44. Today it's 4,500 or something. So it's up 1,000-fold. So it's a pretty big increase. US Treasury yields were 532 in 1871. I don't know where he got that data either. I can only go back to the 60s, but somehow he got this data. Who knows how he did it? He says this is the S&P 500. The S&P 500 didn't exist in 1930, much less 1871. So I don't know where he got this data. But here's his CAPE index. What does this mean? When this blue line is high, he's saying stocks are overvalued. So what is he saying about the stock market today? He's saying this is the second most overvalued stocks have been in history. The only time they were more overvalued was during the dot-com crash of 2000. When the red line is low, he's telling you bonds are overvalued. This is the most overvalued bonds have ever been. So what is he saying? Don't buy stocks, they're too expensive. Don't buy bonds, they're too expensive. Also, real estate's incredibly expensive, so don't buy real estate. Also, commodities are really expensive right now, so don't buy commodities. But other than that, invest your money in good places, right? So there's really no place left. I heard one speaker saying, I don't think there's any bubbles out there, but we've never been in a time where every single asset is at its 90th percentile of expensiveness. Everything's expensive. From your standpoint, you want it to all crash so you can start your IRA and buy cheap, right? So you can invest, but everything is expensive right now. But that's the data he provides. So I took his data and I went back and I just plotted the S&P, the stock market. Here it is in blue. This is the return on the stock market. And what I did in red is I took each decade's dividend yield and each decade earnings growth, and I just plotted it. And you can notice the blue and the red line track pretty well together, don't they? Here's the 2008 crisis. They track pretty well together. Right now, the market's way ahead of its dividend yield plus its earnings growth. So either the market is really expensive, which is what Robert Shiller is saying, or I do have a defense that the stock market may not be that expensive. But according to these numbers, so this kind of proves my case. The stock market does essentially move up with dividend yields and earnings growth, except for recently. Recently is where we've been off. And an interesting thing is, what did 2008 do? 2008 came right back down to the line. In fact, Robert Shiller, for like 37 minutes in 2008, in 2009, he was saying stocks were cheap. And then very shortly after that, he went back to them being expensive. Which if you listen to him, he would have lost out on a really good bull market, right? So why is our stocks overpriced? That's possible. Is it possible they're not? I'm going to argue one reason they may not be is most of this history, there was very limited information, so stocks are really, really risky. We couldn't get data. Today we can get data. And number two, it was real expensive to buy stocks back then. Commissions in the 70s are like $50. Today they're zero. So just those two things. We got more information, so stocks aren't as risky, and it's not as expensive to be in the stock market. We might have had a one-time adjustment on the stock market to reflect those two things, which what that means is, if I'm correct, this line would have jumped up, and going forward, the blue and red line will just be parallel. So I'll be right going forward. The stock market will move up with dividend yields and earnings growth, but it'd be parallel because it is one repricing reflect that it's much cheaper to buy stocks and they're less risky. That's kind of my theory, but who knows if that's correct. And that really probably started back in the 90s. And then we just had a hiccup here. There's the dot-com crisis, but you notice in the dot-com crisis, it didn't come back down to the red line. We kind of recovered, but 2008 definitely brought us down to the line. But since then, 2020 is in there. It's hard to see it, but it's in there. But anyway, so I'm arguing that's what a stock returns essentially, like, that looks right. The second thing I'm arguing is corporate earnings grow essentially in line with the US economy. The red line is the growth of one, or I forget where I got it, but the growth in corporate earnings over time. Can you see 2008 in there? Who caused 2008? The accountants, sorry accountants, but this was the accountants' fault. Why did earnings drop so much in 2008? Because the accountants said, hey, we want to do fair value accounting. That's so cool. Well, you do fair value accounting, you're writing bonds down the market. I know at UTSA, the life insurance company had to write off $2 billion in bonds all in 1 year. That's what that line is. That's a bunch of insurance companies writing their bonds off billions and billions of dollars. And then what happened in 2008? Those bonds all came back, got all their money back. So we had not seen this before, not because we hadn't lost that much money, it's because they changed the accounting, and fair value accounting caused that problem. But the blue line is the 10-year treasury. The green line is the actual growth in our economy. What do you notice about the growth in the economy? Our economy has actually grown faster than corporate earnings. Our economy has grown 6.32%. Corporate earnings have grown 5.76%. Now, why is that? Well, the reason they're not the same, they really should be the same. The reason they're not the same is I'm doing the Standard & Poor's 500. There's more companies out there other than just the S&P 500. And in fact, The companies that are really generating growth are those small companies that aren't in the S&P 500. They're growing really, really fast. And they're much smaller, so they don't have as much impact, but they're growing much, much faster. So those other companies, those smaller companies, they're making up that difference. But I think I can make a strong case that corporate earnings grow about the same speed as our US economy. All right. So those people who say no, corporate earnings grow much faster, you can't prove that with this chart, right? You can see they don't grow faster than the economy. They grow a little more slowly, but I've justified that. And then the last thing is, I love this last chart a lot. Oh, come on. What's the deal? Economic growth. So you've economic majors, y'all know this better than I do, but we'll still look at it. Where does economic growth come from? Productivity, labor, and inflation. I'm missing one thing. What's the one big thing I'm missing? I left out. It's not a big piece. What else do you add? Y'all have had macroeconomics, some of y'all. Imports and exports, right? Net import exports. What does that do to our economy? Is that add or does that subtract? Do we have more exports or more imports? More imports. You take exports minus imports, so that would actually reduce this number a little bit, but it's really not that material. I know it's a big number, but relative to our overall economy, it's not a huge, huge number. So productivity is in the blue, the most important number, far and away the most important number. What do you notice with productivity? 2%, 3%, almost 2%, 1.5%, about 2%, about 2%, about 1%, about 2% on average. Productivity in the United States has been about 2% on average. What is productivity? The Federal Reserve defines it it's actually quite easy. They take the growth in our economy on a real basis, so without inflation, the growth in our economy, let's say that's 3%. They look at the growth and the number of hours we work. Let's say that's 1%. They just take the growth in our economy minus the growth in hours worked, and that's productivity, which makes sense, right? We produce 3% more, but we only work 1% more. What's the difference? We're more productive, all right? So 2%. What's productivity in China? Well, it's like 4 or 5%. But that makes sense, right? Because they're moving people. China was about 70% agriculture, and they're trying to move to 70% industrial. That move is going to be pretty impressive, right? You show up in an emerging country with a Caterpillar or Deere tractor, productivity doesn't go up 10%, does it? You show up with a tractor on a farm that's been using rakes and shovels, their productivity goes up what, like 50,000%, right? It's pretty massive, pretty impressive. I'm really excited. One of the teams is doing the vertical farms. Which one's doing that? Yeah, that's going to be pretty. Have y'all found data on it yet? Email me and I'll send you those economist articles because I'm really excited about that. But yeah, I mean, that's vertical farms. They're far more productive. You can get a lot more produce in a lot less space, less water. It's pretty impressive. So productivity is a huge thing. That's where our wealth comes from. The wealth of nations is productivity. It's the most important number of all. And it was really horrible during these years, not just for the US, but around the world. In fact, President Obama, if you want this article, email me and I'll send it to you. But President Obama in his last year wrote an article for The Economist asking about what he was most proud of, what he was most disappointed about. And he said productivity was the thing that worried him the most. Why was productivity so weak in the US? So, and Nicole told me she was leaving early, which I really appreciate. So don't glare at her. That's perfectly fine. And it's a really good article. I really liked what he had to say. Now, he said the key to productivity was education. Boy, I wish I could get stuck in a cross-country trip with Barack and Michelle Obama and just talk to them the whole trip. That'd be so cool. I doubt that will ever happen, but that would be cool. I would just love, talk about, because he has ideas that I agree with, things I disagree with. Obviously, he's a lot smarter than I am, but I still love the challenge of just kind of, you really think that? But I agree with him. Productivity is so crucially important. I agree with him. It's tied to education. I just disagree with him on how he would get the education to work, because I think he's trying something that hasn't worked too well in the past. But that is key. Productivity. If you want to invest in the world, I would find the country whose productivity is improving the best. and that's probably where you're going to make the most money. So productivity is key. How do you get productivity higher? It is training, it is education, it's technology, it's artificial intelligence, it's robotics, it's all that kind of stuff. What country is doing that the best? The US still leads when it comes to our technological innovation and those kind of things. You know, people ask the question, why doesn't Europe have a Google and Amazon? Why are there no massive tech companies in Europe? Why do they only exist in the US and China? And that's a good question. So that does have to do with the innovation that we have in the US, and it's still, you know, Silicon Valley is still a huge advantage in the US. So that's the productivity. That's what you should be most concerned about. If productivity in the US drops to 1% or lower, we're going to be much poorer 50 years from now than we are today. So it's really, really critical. Immigration, education, those are kind of things that really boost productivity. I forget the statistics on how many new companies in the US are created by immigrants, but it's like 50%. So immigration is a big part of this. So that's productivity. What can you expect it going forward? We've had a horrible decade of productivity. People aren't really sure why that's the case, but it's been pretty weak. Will we get back to stronger productivity? We'll just have to see. Labor growth, the 2000s was the first decade in US history where we had fewer workers at the end of the decade than we had when we started the decade. The first time in entire history. Why is that? Well, because in the previous decade, we hired a bunch of people in banking and construction to do all this shadow banking and all this other stuff. And then the subprime crisis crashed and all those people lost their jobs. So we kind of overhired for a decade, and then we had to get rid of all those people. But we've actually had, you know, kind of decent economic, really strong labor growth in the 60s and 70s. Where did that come from? Any guesses on that? Who suddenly showed up to work in the 60s and 70s? That's women coming into the workforce, right? So we're not going to repeat that unless we go back to child labor or something. It's going to be tough to get that kind of growth. So where does that labor growth come from now? We can either have more babies or have more immigration, all right? The replacement rate around the world, it keeps dropping. People are having fewer and fewer babies. Japan, they're trying, President Abe in Japan is like, how can I get people to have more babies? And that's the tough thing to do. How does a government get people to have more babies? You know, preschool care and, you know, kind of child credit kind of things, but that's usually not enough. Having a baby is a pretty serious thing. So having a little bit of child care help or having a little, you know, give me an extra $500 a year, that's not much for a kid. So it's tough. The world is not having as many babies as they used to, and that's tough, and it's gonna be tough for labor. That may be great news for you guys, because all these baby boomers are retiring, you're gonna be replacing them, so it might be great for you, even though you'd be working 70 hours a week, at least you don't have to worry about unemployment. So labor growth, what can that be going forward? A lot of people think it's gonna be negative because of the baby boomers retiring. So we either got to figure out our immigration policies or people are gonna have to start having babies. Inflation is inflation. You know, that's not a good reason for our economy to be growing, because it's, you know, it's just everything costs you more. So that's kind of a fictitious one. So it really does come down to productivity and labor. I'm in the camp that believes if productivity really takes off, then it's probably because labor is shrinking. So that's what Japan's doing, right? I think it's really sad to me to see it in Japan, but Japan has a lot of elderly people, and they show, I don't know if you've seen these videos that these elderly people, their best friend is a robot, and they're talking to them like a real person. That seems, I know I can see myself at 80 years old and my best friend's the robot. That just seems really pathetic to me, but that's what it is. They don't have enough workers, and they're using robotics. It's great that they have robotics, right? Japan is kind of leading the world in robotics, but can that really save us on this labor crisis? So we'll see. We're seeing more kiosks and those kind of things. So that's something your generation is going to be going. I know y'all have seen articles that AI is going to replace 40 to 50% of jobs like accounting and finance. I'm not so sure that's really true. If I were an accounting major, I wouldn't worry too much about that, but it is going to replace a big chunk of finance and accounting. So you better be learning coding. I don't know how many of y'all are doing coding, or how many Python experts do we have in here? A little bit. Boy, if I were you, I would be desperately learning Python and SQL and Java. I would be desperately learning those. That is your future. Boy, I can't, you don't have to take a class, just go the Code Academy and teach yourself and start learning it. I have students that know it backwards and forwards. I mean, one student I had, boy, he knew it backwards and forwards, and he was training all these Stanford and Harvard grads because he knew Python and they didn't. But boy, it is taking over the world. Some schools are completely oblivious to it, and boy, they're going to be so far behind. So how do you protect yourself from AI? You learn how to code. I don't care if you're marketing, accounting, finance, cybersecurity, management, learn how to code. Really, really critical. I don't know, does UTSA have Python classes you can take? So you can get some designations, right, and learn that. So really, really critical stuff. So I think that's the key, is we might see productivity is going to have to go to 3 to 4% because labor is going to be negative 1%. If productivity stays at 2 and labor is minus 1, our economy is not going to grow very fast at all. We're going to be much poorer in the future. So we really got to get that. We got to get productivity up, and we got to find some way to get workers in there. But that's what we're after. So if we're going to try to figure out what the stock market's going to be doing going forward, we're going to figure out what our economy is going to be doing forward. What is productivity going to be? What is labor growth going to be? And what is inflation going to be? So they really should have picked another key besides the escape key. So productivity, I'm going to argue, if you go much above 2%, you're getting pretty excessive, I think. Could you go 3? 3 to me is artificial intelligence, robotics, autonomous vehicles. I think autonomous vehicles could have a huge impact on our productivity. What else is there? Nanotechnology, mRNA, what is printing? 3D printing, that could have an impact. Drones, could drones have an impact? You know, instead of having to waste time going to the grocery store, everything just shows up in a drone and we don't have people delivering it to you. You know, there are things out there. People say, wow, we got all these exciting productivity things. And I remember watching a conference and they said, yeah, that's exciting. But back in the early 1900s, we were adding electricity. We were adding cars. We're adding airplanes. Are any of the things we're doing today as important to productivity as electricity? If you think of anything that's like the next electricity, that's a pretty huge one, isn't it? Telephones is a pretty huge one. Cars is a pretty huge one. You know, think about it. In the 1900s, they were traveling from what, Atlanta to Washington, D.C., and they took what, 3 or 4 weeks. Today, some of the poorest people in the world are traveling around the world for, you know, a few $100s. I mean, it's just amazing the productivity gains. We've got a lot of them. So I don't think it's all that impressive, AI and robotics versus what we've done in the past. So, you know, 2 to 3% productivity, or 3% to me is like a pretty massive number. Labor growth, the highest I go there is 1%, and that's all about immigration. I'm a very pro-immigration person. I deal with a lot of people from, especially from Asia, a lot of people from Pakistan and India. Boy, they've got some skills that are really valuable to us. Pretty impressive. I'm glad they're here. We had one student from France, one of my best students ever. He couldn't find a job here because no one would sponsor him. I was like, man, I don't want you leaving. We need you here. He finally got a job at Rackspace because they sponsor. So yeah, I mean, there's a lot of very high quality, trained, very well educated people who want to work in the US. We got to figure out a way to get them in here. But we also need unskilled labor, right? That's what Japan's facing, right? They need people to take care of elderly people. It's not necessarily high skilled they need. So immigration is a big part of that. So that 1% growth to me is we get the immigration problem figured out and we get a good workflow. And inflation, the Fed says their goal is 2%. They're obviously failing miserably right now, but inflation is inflation. So our economy, I think, can grow 4 to 6%, which means I think corporate earnings can grow 4 to 6%. That's kind of my range. I'm not saying you can't go outside of that range. I'm saying you can go outside of that range with a really good argument, some special thing that you think is going to happen. Anybody want to argue for 5 to 7%? That's what you're hoping, right? This is your career, this is your life. If it's 4%, your generation is gonna be much poorer than my generation. 4% is a pretty weak number. If it's 6%, your generation will be very wealthy and be very well off. All right, so that's what we're looking for. So essentially, the dividend yield today, we can get that. We just go over here and we type SPY, which is an ETF for the S&P 500. And it gives us the current yield. It's 1.3%. Historically, that number has been 4 to 5%. And then expected earnings growth, I'll just say 5%. That gives you what? A 6.3% expected return on stocks. Now, there's one adjustment we can make. I'm actually going to boost this up to 2.1%. Why? Because a lot of companies are not paying dividends. Instead, what are they doing? What did you see on paper one? Instead of paying dividends, they're doing what instead? Well, not reinvesting this. We're talking about cash getting to stockholders. How are they getting cash to stockholders? Not issuing, because that'd be cash from stockholders. But what did y'all see in paper one? Repurchasing. Right. There's papers out there that says you need to add about 0.5 to 1% to the dividend yield, because instead of paying dividends, they're still buying. It's the same thing, right? You can pay a dividend, which sends money to your stockholders, or you can buy the stock back. It's essentially the same thing. So if you do that, you get something in the 6 to 8% range, which I think is a pretty reasonable. So if you're buying stocks today in general, just the general stock market, you're probably getting somewhere in the 6 to 8% return. Historically, stocks have given us 10%, but that was with much higher dividend yields and much higher inflation. Inflation's lower today, I mean, expected. All right, so we'll come back to this and finish it up. I love this topic. It's really, really critical topic, actually.